What's up everybody, welcome to another episode of China Update, where I provide you guys with the most up-to-date political, economic and geostrategic analysis on the world's #2 economy. My name is Tony, let's jump in. Happy Saturday everybody, I hope you're having a lovely start to the weekend. Today I wanted to discuss a fantastic report published over the weekend by Chang Siwei and Zhang Yukun at Chinese financial outlet Caixin, which explores the increasingly difficult budgetary challenges local governments are facing across the country. Local governance is a theme which we have discussed many times on China Update, an area which I believe is heavily underreported but critical to understanding economic and political trends in China. So the report starts with a case example of the coal-rich northern province of Shanxi, home to Xi'an, city of the Terracotta Warriors. In 2021, last year, the province enjoyed a nice fiscal surplus. In its general public budget, the province's revenue was 277.5 billion RMB, just over $43 billion in 2021. This was 17.1% higher than planned, while its 606.9 billion RMB in spending was lower than projected by 4.6%. And Shanxi wasn't alone. Many other provincial level regions saw their general public budget revenue beat expectations last year. Out of the 31 provincial level regions on the mainland, 18 reported double-digit revenue growth rates. Total revenue in local general public budgets on the Chinese mainland saw 10.9% year-on-year growth. Why the great year last year? Well, many local governments recorded high revenue growth rates last year thanks to the low comparison base, the low base rate of 2020. And the nationwide economic recovery from the pandemic, which we'll touch on in a moment. There is also the fact that several provincial level regions only exceeded their revenue targets last year because they had set them so low. Now we do have to look a little bit closer at all this. The devil is in the detail after all, and we do not want to make the fallacy of composition. Some local governments did have a painful year last year. Henan, for example, saw very damaging flooding. Some cities resorted to turning to extra budgetary measures like predatory fining of companies and households, or pressuring local government financing vehicles to buy land to make ends meet. We also remember that in December, the city of Hegang in the northeastern region of the country essentially defaulted and had to go through a form of restructuring. So not every local government or region had a great 2021. We also need to remind ourselves, of course, that just because local governments were doing relatively well last year doesn't mean that this applies for the entire economy. Household demand has yet to return to pre-pandemic levels, to give one example. So, like any large system, the situation is complicated and complex, but all things considered, we can say that in 2021 it wasn't too bad a year for the fiscal health of local governments. However, 2022 looks to be a very different story. Quote, "This year, most regions expect their revenue to grow at a slower pace and have warned that they will be on a tight budget as the country struggles with managing continuous COVID flare-ups and an ongoing property slump that dampens the prospect for land sales, a main contributor to local government funding in China." End quote. And quickly guys, if you're enjoying the content, always a huge help if you hit the like button. I really appreciate the support. If you can just click that button, it really helps the small channel. And if you're watching for the first time and you're finding you're getting some value from this sort of content, maybe consider subscribing. I release one of these every day. If you want to be on top of China and the developments here, hit the bell notification with the subscribe and you'll get these updates as they're released. Okay, let's continue. The Caixin report predicts accurately, I would argue, that land sales, that is land use sales, will continue to decline this year. This is a process which we have explored thoroughly on China Update over the last few months. According to Wu Qiying, a macro analyst at GF Securities Co. Limited, featured in the Caixin report, in China the general public budget and government-managed fund budget are the two main parts of the government's fiscal budget, and that revenue from land sales, again land use sales, to developers has made up about a quarter of these two parts combined in recent years. The chief China economist at Nomura Holdings Inc. estimates that China's land sales revenue could decline by more than 2 trillion RMB in 2022 alone. This coming down from 8.7 trillion RMB in 2021, a revenue drop of over 20%. Local government budgets, which were published well over a month ago, almost 2 months ago now, which we covered at the time, indicate that local authorities are very much aware of this. And in some cases, the decline in land sales revenue is much more like a collapse, with the local authorities with the southwestern province of Sichuan predicting a drop of more than 50% in revenue from the source. The Caixin authors express the issue using very gentle and politically correct language, saying simply, quote, "Growth in revenue from land sales may further slow for some regions in 2022, as local property markets remain gloomy. This could strain the revenue sources of local governments." End quote. And if this wasn't bad enough, analysts predict also that spending obligations are set to go up for local governments at the same time. And indeed, we are already seeing this. Late last year, as we discussed at the time, boosts in consumption and exports after the low base year of 2022 at the beginning of 2021 resulted in a better than expected economic rally. We know, of course, that the strong recovery was short-lived, however, and by Q3 of last year, China was facing economic slowdown again, and then the Evergrande crisis blew up. But what this meant for the first 2 quarters was decent, healthy growth. So at that time, local governments received decent tax revenue, but also didn't need to turn to extra infrastructure spending to reach growth targets. 2022, on the other hand, is another story. Quote, "Local governments are now gearing up to boost infrastructure investment in 2022 in order to stabilize economic growth. Expenditure is projected to grow 8.9% in local general public budgets and 19.3% in local government-managed funds. With an expanding expenditure, local governments will have to issue more special-purpose bonds, but strained revenue may drive up their debt-to-fiscal revenue ratio and thus limit their ability to borrow more." End quote. The piece continued with, quote, "Meanwhile, the central government's campaign to eliminate hidden local government debt, off-the-books borrowing chiefly used for infrastructure and other public policies, could also add to local government's debt burdens, as they'll likely have to issue more bonds to move their hidden debt onto the balance sheet." End quote. It's going to be a bumpy year, but just like last year, we will be following it as it unfolds here on China Update. Before we go, we need to discuss Yuzhou Group Holdings, yet another developer sucked into the Evergrande Housing Crisis black hole. The developer is seeking support from state-backed investors to take over $500 million worth of debts owed to domestic and overseas creditors, which is coming due in April. This company is already in hot water though. A few weeks ago, it made its first public default, missing payments on another $500 million bond. The most recent data also indicates that Yuzhou has 15 outstanding dollar bonds with total value of nearly $5.8 billion. Sales for the company have collapsed also. In the first month of 2022, the first 2 months, of 2022, its contracted sales dropped 42% year on year to 4.5 billion RMB. Chinese financial outlet Yicai and soon after Bloomberg's Hong Kong unit reported today that the developer Yuzhou is, quote, in talks with state-backed investors with the assistance of local authorities to transfer some of its domestic bonds to new investors, a deal that is likely to offer the cash-drained company 1 more year to repay the notes, end quote. Ultimately, Yuzhou wants to gain funding to pay interest on these upcoming notes. Analysts with Bloomberg point out something interesting too, a trend that we have seen with other developers. Quote, Yuzhou's dramatically diverging bond payments show that local and global investors are betting on wildly different outcomes for their investments in the developer. The company's most active onshore note is priced at more than 70% of face value, according to data compiled by Bloomberg. By contrast, most of Yuzhou's dollar bonds have fallen to about 10 cents on the dollar since the company missed a dollar note interest payment earlier this month, end quote, suggesting that domestic lenders in China are far more confident that they will get their money back than foreign ones. Hey guys, I'd love to hear what you thought about some of the updates we covered in today's episode, so throw your comments below. Always love hearing from you. Thank you for watching. I'll see you next time.